All right, it's 2 past, so we'll get started. Thanks everyone for joining and for jumping on. Very much looking forward to spending the hour with you and giving you a little bit of an overview of DeFi and the future of finance. By way of introduction, my name is David Engel. I'm the FinTech Business Development Manager for ANZ. So my role is focused on accelerating the growth of our FinTech customers and then accelerating the growth of the ecosystem. And part of the ecosystem growth is about identifying what we think are the big trends in FinTech, both in Australia and globally, and then trying to identify ways that we can accelerate the growth of those areas. And obviously, decentralized finance is one of the biggest bets that you can make, and both personally and professionally, I'm starting to spend a lot more time on that. And one of the things that I like to focus on is on education and enablement. So that's the purpose of this presentation. So very quick mention before we get started. The content discussed on this webinar is intended to provide general information for educational purposes only. It does not take into account the financial situation or needs of viewers and should not be relied upon as a financial product or advice. So I just want to get that in the clear up front. What are we covering today? We're going to start with Down the Rabbit Hole, a little bit of an overview about the accelerating interest in DeFi and crypto and what that actually means for all of us. Then we'll talk about DeFi and Web3. So how does decentralized finance position in this thing we call Web3? And we'll do a bit of an explanation about what Web3 is as well. We'll then talk about a few DeFi specific ideas, stablecoins and smart contracts, which really are the foundations of the explosion in decentralized finance. And then finally, a quick overview of what else is there, what can you do, how do you get started? Presentation principles. So the first thing to note is that the more questions that get asked, the more interest people show, the more successful I will feel this is. The purpose of this is to pique people's interest, to generate curiosity, and to get you starting to think a little bit more about what is this world of blockchain and decentralized finance. So I very strongly encourage people to ask questions and please ask them publicly. So in the chat, you can just go and select everyone. Please use chat rather than Q&A. Q&A goes just to me, and there's a fair chance that I'm not going to see it or won't have time to answer it directly. So the ask is that you go into chat and select everyone. And then there are people on here. I'm seeing a lot of names on here of people who know more than I do about this area. So one of the cool things about that is that they can answer the questions. So this is a community. One of the things that I love about this is that it has a very community vibe. So I would ask those that have answers to the questions asked, go ahead and answer them. Don't wait for me, just pop in your opinions. I would just ask that everybody be kind and patient and generous with their encouragement and their feedback and their answers. Finally, this is forever a work in progress. This deck, my learning experience in this. And what that means is that I really do strongly encourage feedback from everybody in the audience. What did you like? What didn't you like? What should I spend more time on? What should I spend less time on? I've done this presentation 6 times now, and every time it's been because of people's generous feedback that allows me to iterate and improve. And I ask the same thing of everyone on here. So we've got a survey that we'll distribute at the end. That's just 3 questions. Please fill that in. That just gives us some qualitative and quantitative feedback. And then if you want to message me on socials, I'm on both Twitter and LinkedIn. You can just find me by my name on both of those. I would really welcome any feedback that you guys have so that we can continue to improve this presentation and make sure that it hits the mark for the audience. Okay, first things first, down the rabbit hole. So I imagine everybody knows the story of Alice in Wonderland by Lewis Carroll. There is a concept in there by the rabbit hole. Which means that you fall down a rabbit hole and go deeper and deeper and deeper and deeper and deeper. DeFi is very correctly, and crypto is very correctly referred to as a rabbit hole. Up until about 2017, it was a rabbit hole really only for technologists and investors because it was just not that user-friendly. It was hard to access for the public. There weren't that many on-ramps. So if you were a technologist or a cryptographer and you were really interested in those concepts, then you would fall down the rabbit hole and start spending time and money and resources on it. Or if you were an investor. What's happened in the last few years, especially really in 21 and 22, is that the on-ramps to the rabbit hole are leading to an explosion in interest. And when we say the on-ramps are increasing, there are no shortage of ways that people with a wide variety of interests, whether you're a celebrity worshiper, an art aficionado, a gamer, a sports fan, a mainstream investor, that you can become interested in this area. My interest came through FinTech. So obviously, I spent a lot of time thinking about FinTech, and I just started spending more and more time down the FinTech and finance rabbit hole. And we'll talk about that a little bit more. But the main point is that there is no shortage of ways to become interested in this. The explosion in interest is because there are so many more ways that people can become interested. Everybody on this panel or in the audience here, I assume, has some sort of interest in FinTech or finance. So the point that I want to make is just find your rabbit hole. There are, if you're in invoice financing, there's applications there. If you're in international payments, there's applications there. If you're in consumer lending, there's applications there. There's no shortage of rabbit holes. And I encourage people to just start researching, start having a look around. You'll know you found it when it doesn't feel like work. I'm just lucky enough that my Venn diagram of personal interests and work interests cross over significantly. And so when I get to do these presentations, it doesn't feel like work. And that's kind of how I know that I've found my rabbit hole. Find what interests you rather than crypto broadly. Crypto is just too broad to be an expert in crypto. So find what's interesting to you and then just read. There is an absolute immeasurable amount of content out there. In my opinion, and this is very much my opinion, to learn, Twitter is a really, really good place to learn. LinkedIn is great. I post on LinkedIn probably more than Twitter. But in terms of just getting down the rabbit hole, unstructured conversations, really smart people, sharing really interesting points and counterpoints, Twitter is a wonderful place if you just identify a few people that are interesting to you and then start following them. White papers are better than periodicals. White papers are actually pretty easy to read, white papers being basically the foundational document, both technical and business, for a range of different protocols. We'll talk about what protocols are, but I would encourage you to read white papers, and then podcasts, in my opinion, are better than books. The only reason being that podcasts are dynamic, forever being updated, and books are static. So even reading a book about blockchain that's 3 years old is going to be so out of date that the lessons that you'll take out of that will have already been iterated on, a dozen times. So I would encourage you to continue to stay up to date, use the most modern tools that you can. Twitter, white papers, and podcasts are the three that I enjoy the most. Find your own. Would love some good podcast recommendations. So if people can remind me at the end, I'm happy to talk about some podcast recommendations as well as some Twitter handles that I would encourage you to follow. Okay, now before we get started, I want to provide a word of caution. I assume everybody on here is old enough to remember the second Iraq War. There was something called the Rumsfeld Doctrine. He was the US Secretary of Defense, and he liked to talk about when they went into Iraq, there were the known knowns, the known unknowns, and the unknown unknowns. Awesome, thank you for posting that. Yeah, and guys, please do post podcast, Twitter handles that you follow. That's great. You could make a pretty easy call that Rumsfeld got these wrong if you look at the way the Iraq War went, but that's not a rabbit hole we're going to go down. But the point is that when it comes to DeFi or when it comes to crypto, what I know is a tiny bit. I know more than a lot of people on LinkedIn. I know less than most people on Twitter. So kind of that's where I position myself. What I know that I don't know, let's say, would be 20x what I know. What I don't know, I don't know. The amount of information that is out there is vast, and it's growing every day. The amount of new projects, new people, new resources, new tokens, new central bank digital currencies, new white papers that are being put out there on a daily, weekly, monthly basis is overwhelming. So the reason that I bring this up is that what I am sharing today is a fraction of a fraction of a fraction of a fraction of what's out there. And really what I'm sharing is what interests me. So the things that I like doing is I like taking complex financial concepts and explaining them to people in the hope that it will help businesses or consumers learn new things, or businesses try new things or experiment more. So that's the rabbit hole that I've gone down, and that's really what I'm going to be sharing a little bit of today. But it's just to say that there is no shortage of information out there. There are going to be people in the audience who are going to have completely different perspectives, different rabbit holes that they want to go down. So I'd just encourage, it's just another way of saying, do your own research. Okay, and thanks everyone. It's a great chat going on. I love seeing that. That's really encouraging. Okay, DeFi and Web3. So the first thing that I want to do is basically just position where DeFi fits within this idea of Web3. And to do that, we'll start with a very simple concept of what is Web3. So this is a tweet that I think sums it up probably the simplest way that I've seen. Web 1 was read only. So if you think back to late 90s, early 2000s, the way that we engaged with the internet was by going onto a website and consuming content. And the people that built that content, the people that built that website, were generally very technical, had strong developer capabilities, generally had a big team, knew how to set up servers, and were creating websites, static web pages that were really one way. And that was Web 1. Web 1 was just about consuming content. As a consumer, I didn't contribute, I just consumed. Web 2.0 then switched it from the ability for me to just consume content one way to actually contribute content. So in Web 2, I could post on Facebook. I could create a tweet. I could post on Reddit. I could write a blog. I could go on Squarespace or on Wix and create my own website, really with no technical skills. And so the transition from Web 1 to Web 2 was from the ability to just read content to the ability to read content and contribute content. And that was Web 2. The transition now from Web 1 to Web 2 to Web 3 is that content that I am putting on online, I now have the ability to own that. And that is what Web 3 is. So we will see a proliferation of social media channels or social media pages where I could own my own tweet. And if that tweet goes viral, if that tweet is really, really popular, if that tweet leads to somebody buying a certain token or joining a specific organization, I can then, because I have proprietary ownership over that tweet, because it is on chain and immutable, and we'll talk about what that means later, but just throwing those concepts out there, it means that I have the ability to own that tweet, own that own that share in a company, own that share in a decentralized autonomous organization, own a coin, own an NFT, own some sort of other digital asset. And so Web3 is basically just building on the ability to read, then the ability to write, and now I can own that content's on there. So that's Web3. And then if we add DeFi, put simply, as soon as you can own an asset, you can then use that for finance. So now that I can own a digital asset online and on chain, meaning on the blockchain, I can take that asset and I can lend it out to someone and earn a yield, earn interest. Or I can use that asset as a collateral and borrow against it. So very simply, all DeFi is taking the ability that Web3 gives us to own a digital asset, a unique digital asset, and then to lend and borrow against it. So it's actually, conceptually, it's very, very simple. And what we're going to do now is we're just going to start to peel back the layers a little bit by little bit and talk about what does that mean? How is that actually built? What are the different components? But I just want to outline that to begin with so that we understand that DeFi is really just the ability to lend and borrow the assets that Web3 is going to allow me to own. Okay, what we want to do here is I'm actually going to do a demo, and the demo is for the purpose of showing you the key features of DeFi. It's easier than talking through them. It's a more interesting way, and hopefully it just helps to bring to life a little bit, not just what the principles of DeFi are, but how they actually very practically apply when you are doing something in DeFi. So what this is an app, a decentralized app called Uniswap. Uniswap is a decentralized exchange. I'll explain what that means in a little bit, but basically on Uniswap, it's an exchange where I can go and I can take one form of cryptocurrency and exchange it for another. So just like in a centralized exchange, so in Coinbase, I can take my dollars, which is just one kind of currency, and swap it for Bitcoin or Ethereum or anything else. On Uniswap, I can take my crypto assets and swap them for another crypto asset. It's basically a way to buy crypto assets. So I start off, it's just a web browser. I simply go on, this is on my phone. The first thing that I do when I go onto that web browser is I select my wallet. I'm going to show you what that looks like, and I'll talk through it as it's going. So I go in, it gives me an option of selecting different wallets. The wallet that I use is MetaMask. So it flips over to my MetaMask app. MetaMask then says, do you agree to share your wallet credentials? So you see those numbers there. That is my wallet credentials. That's how MetaMask identifies me. And that is my balance. So that's a really important point, because what that is a demonstration of this concept here, trustless. So I'm sure people have heard the term trustless. Trustless is the fundamental concept, or a fundamental concept, of blockchain and of DeFi, in that none of these apps need to know who I am to be able to execute a transaction. In the CeFi world, in the centralized finance world, I have to go through know your customer. I have to go through KYC before I can go onto an exchange and exchange money, before I can go onto a centralized crypto exchange and buy crypto tokens, before I can take out a loan, before I can set up a bank account, because that is a requirement of the government to show that I am a trusted individual, that I'm not a terrorist, that I'm not a money launderer, whatever these things, anything else. And so those are trusted solutions. DeFi is trustless. All that Uniswap knows about me, the app that I'm going into, is that I have a MetaMask account that is a real account, and they know that by my MetaMask ID, and that I have enough of a balance in that account to execute the exchange. So that's what trustless means. It means that rather than having to trust centralized institutions, my driver's license, a utility bill, my bank statement, my passport, it is trustless, and that as long as I have a wallet, my MetaMask wallet, I can go ahead and execute this transaction. And that wallet is a front door to anything I want to do in DeFi. And if it is a truly decentralized app, then it won't ask me for KYC. It's only ever going to ask me for my wallet credentials. So that's number one. So now I've gone into the app, and I'm now going to select which token I want to swap for. So I've selected Ethereum, which is in my MetaMask wallet. And now I'm going to select which token I want to swap for. The thing to note on here is that there is no person in Uniswap that gets to say to a token provider. So all of these here are token providers. They're different cryptocurrencies with different functionality. There's nobody within Uniswap that says, this token, yes, you can go on there because we trust you, we like you, you're compliant. And there's no one that says they can't go on there. It is permissionless. So as long as the token that is going to be listed on Uniswap follows the Uniswap requirements, and there's certain liquidity requirements that you have to match your token with a certain amount of Ethereum. I'm not going to get into the details why, but it's basically almost like a security to make sure that it's not a fraudulent token. That token can list on the Uniswap app, which again is fundamentally different than if I am going to list on the Zero marketplace or on the Zapier marketplace. In order to be able to list on there is a person within those companies that I'm going to deal with from a commercial perspective, then I'm going to talk to their compliance person, I'm going to talk to their info security person. Those are all permissioned ecosystems. But in DeFi, it is permissionless. Any coin can list on there as long as they follow the protocol. And because it's on the blockchain and because it's immutable, the security is built in and the trustlessness is built in. So that's principle number 2, is permissionless. So I'm choosing a token. I chose Aave, which is a lending token. I'm going to go ahead and do the transaction. I'll just point a couple things out here that are interesting and relevant. So it might be hard for you guys to see here, but you can see where it says price impact. What that is saying is that this transaction, if I do it now, is going to be put into the next Ethereum block. So blocks are basically the ledger that gets printed on Ethereum every 12 seconds, and that's what makes it immutable. Every block has the history of the transactions. This transaction, if I'm giving it permission to say the price can slip by 0.01% within the block or the next block or the next block, and it can go ahead. But that just shows how fast these transactions are. If you think about it, if you do a currency swap on a currency app, you're basically going to get that price for the day. It doesn't swap over at that frequency. So it just shows you how fast it moves. So I'm going to confirm the swap, say, yes, I'll do it. I don't actually do this transaction. This is for illustration purposes only. It then comes up with the estimated gas fee. Gas is what it costs for me to actually get this transaction printed on the blockchain. You notice that the gas fee for a $1,500 transaction is $115. So it's very expensive. I'm not going to get into the details about gas fees, but let's just say that it is one of the biggest barriers to the scaling of DeFi because it is expensive to do a transaction. If I'm doing $1 million swap, it's fine. If I'm doing a $1,500 swap, then that is 10% of the transaction cost. So you're probably not going to do it. Okay, but I'm going to reject that transaction. So that was showing that. Now there's a couple other points that I want to highlight here before we go in. So I reject that. The third point is that it's composable. So if you look down here at the bottom, you'll see that it says swap and it says pool. These are pieces of functionality that are from the Uniswap protocol. So Uniswap, which is this app, is also what's called a protocol, meaning that these are just pieces of functionality that anybody that wants to build a decentralized app on top of can build. And that's what we mean by composable. So Uniswap is not the only company that can use these. Think of them as APIs. Anybody else that wants to go and build on top of the Uniswap protocol can build an app that uses the swap functionality and uses the pool functionality. And there are hundreds and hundreds of these protocols that are fully composable. So I could take the Uniswap swap functionality, I could take the Aave lend functionality, and I could take the MakerDAO stablecoin functionality and compose those into a single app. So it is composable. Next thing I want to show, and this is a great app because it kind of shows you everything, is, sorry, we're going to move on from the pool and we'll go to vote. So this is a really good illustration of what we mean by decentralized. So there's decentralized technology. That's just what the blockchain is. We'll talk about that a little bit more. But there's also decentralized governance. And decentralized governance means that there is nobody at Uniswap. There's no CEO, CFO, board of directors that are now making decisions on budget allocation, on what projects get approved, what projects get declined. Rather, there is a Uniswap governance token, which is freely available on the open market. You can buy it on Uniswap. You can buy it on plenty of crypto exchanges. If I own that token, that lets me vote in the Uniswap proposals. So anybody, including myself, can go and click on create a proposal, and I can create a proposal. I can say that Uniswap should increase their take fee to 50%, or that Uniswap should go and sponsor Real Madrid. And then those proposals will get put into the proposal section, and at certain interims, they get voted on without the need for a CEO or board of directors or anyone else. And you can just see the list there. You can go and Google Uniswap if you want to see. But that is what we mean by decentralized governance. You have a token and you can vote. So again, that is one of the principles of decentralized finance. If it's truly decentralized, we'll have a decentralized governance structure. And then the final point is transparency. So within the Uniswap app, I can go and see at any point in time how much value is locked away. So how many people are holding their tokens on Uniswap, what the value of those tokens are, how many new tokens have been created, what the value of the Ethereum locked away for those tokens is. And that is always on, always transparent. And again, that if you think about the difference between centralized finance, if I want to find out the transaction volume through one of the card schemes, I can go and look at their annual report, which I can get once a year. Maybe they put out some thought leadership every quarter, but that is the opposite of transparent. That is locked away and shared when they want to whom they want. Blockchain and DeFi is completely transparent. So you always have the ability to see total value locked away, pools, tokens used, and things like that. So, hopefully that was a helpful illustrative purpose of the key features of DeFi, which really are the key features of blockchain. And we'll move on now. Okay. So what is the actual Web3 architecture? And it looks like, so can somebody actually just pop in questions and just put my name in caps if there's something that I need to answer? It looks like everything's going swimmingly. This is great. So what is Web3 architecture? So what I want to do is just show how the world of Web3 fits in with kind of the world of Web2 or off-chain. So the first thing to know, there's three basic components between Web3 and the rest of the world. So you have what we call the blockchain or the metaverse. That is the decentralized ledger that everything sits on. We'll talk about that in a minute. So that's what we call on-chain, is another way of talking about that. Anything that sits on the blockchain is considered on-chain. Opposite of on-chain is off-chain. So that is anything that is on a centralized database, a centralized ledger. So, I bank at NAB, that's off-chain. My land title is within PEXA, that's off-chain and centralized. My credit scores with Experian, that's off-chain and centralized. So those are the two opposite worlds. And then connecting those worlds is the on-ramps and the off-ramps between the blockchain and off-chain. And there are a few different things that can connect those. So, pardon me, you have wallets, MetaMask just being one of many, and wallets are a way of getting, either NFTs or cryptocurrencies from off-chain to on-chain. You have exchanges. So I'm sure everybody here knows like FTX, SwiftX in Australia, BTC markets in Australia, Coinbase. These are all exchanges. Some are centralized and some are decentralized. And then you have what are called Oracle networks, which rather than moving currency or rather than moving assets, move data. And I won't spend a lot of time talking about them now, but Oracle networks are really going to be a critical piece of the infrastructure of DeFi, because what that allows us to do is to get data from off-chain. So we can get payment information, you can get invoice information, lending information, credit scores, and you can verify those cryptographically via an Oracle network and then put that off-chain data into on-chain. And so all of a sudden, I could do invoice financing with off-chain invoices, but I could then do that on-chain. Or I could take a land title that used to sit off-chain in Pexa, move that on-chain, and then move that around without requiring any centralized institution. I could fractionalize that, so I could break that up into 10 different NFTs, and we'll talk about that in a minute, and then start to use those as different assets. So this is the technology world, blockchain, the ramps, and then off-chain technology. And then underneath, you have the governance world, which we've spoken about a little bit previously, and we'll talk about a little bit more. Now, one thing that I want to note, okay, so then if we want to get back to DeFi. So within the on-chain world, there's really only a couple of very basic building blocks. There are what are called ERC20 tokens, and this is Ethereum. It's different for other layer ones, and we'll talk about that a little bit. Those are fungible tokens. So it's literally just like in the real world, I can take $1 and that's the same as another dollar, which is fungible. You can interchange them. I can take one Apple share and interchange it for another Apple share. It's no different with ETH or with Bitcoin or with any other cryptocurrency. They're fungible, fully interchangeable. And then the other side is the non-fungible tokens. Everybody's heard about NFTs. We'll talk about kind of the future of NFTs as it relates to DeFi, but there's only two kinds of crypto assets. It's either fungible, interchangeable, or non-fungible. And then again, as we spoke about before, DeFi is just the financial movement of those assets and the lending of those assets and the selling of those assets. So that, very simply, is what Web3 architecture looks like. Now, when we talk about decentralization, I think this is a really important point. There are going to be as many exceptions to this slide as there are rules. So I'm not saying that this is definitive. I just want to use it for illustrative purposes to help understand kind of where the idea of decentralization and centralization fits in to this architecture. So blockchain should always be decentralized. There are permissioned blockchains, which means that you can only get access to those with permission versus permissionless. But blockchains are, by their very nature, decentralized technology. Ethereum is the most popular one, has the most what we call total value locked, the most assets on it. But there are other what we call layer one blockchains, Phantom, Solana, Polkadot. All of these are blockchains, distributed ledger technology that people can now build on top of. So that's the blockchain. Then we talk about the on-ramps and off-ramps. So we talked about the asset on-ramps and off-ramps, which are wallets or crypto exchanges. There are centralized wallets and centralized exchanges. I've named a whole bunch. Most of the most popular crypto exchanges like Crypto.com and Coinbase and FTX are centralized, are majority centralized. And this isn't a judgment for a good reason. It's just much, much easier to use. It helps scale it to the masses. It's easier often to get investment because investors sometimes have a higher level of conviction or safety in it. It's easier to be regulated. So there's many, many very valid reasons to have a centralized exchange, but then you also have decentralized exchanges. So an example of those would be Uniswap, which I just showed you. Another one called SushiSwap. There's a derivatives exchange called DYDC. So there are both centralized and decentralized asset on-ramps and off-ramps, and then the same thing for oracles. Although oracles are really moving more towards decentralized over time, and then off-chain, if it's off-chain, it's centralized. I mean, unless it's, I suppose it's a commune or a kibbutz, or something. Off-chain institutions and assets are centralized. And then the bottom layer, which is an important distinction, is then the governance. So if I'm a centralized institution, I have centralized governance. What we are seeing now, and this is a really important distinction when we talk about decentralization, is that there is decentralized tech. So blockchains are just technology, and that technology is decentralized. It is a distributed ledger where the ledger is printed on tens or hundreds or thousands of different ledgers that are distributed across many, many different servers. But then you also can have centralized or decentralized governance. Decentralized governance is generally done through an organization called a DAO, a decentralized autonomous organization. And decentralized autonomous organizations are basically ways that you can do two things. One is, in a decentralized fashion, you can pool capital. So you can have hundreds or thousands of people who are completely unknown to each other pool their capital into a decentralized wallet without ever knowing who they are. And effectively, what you've just built is a company with a treasury that company can then go and spend. So DAOs are a way to trustlessly build a company or an organization, let's say. Companies isn't the right terminology because that has centralized connotations, to build an entity that can then go and build things, buy things, distribute things, and with a decentralized wallet, with a decentralized treasury. So people may have heard about the Constitution DAO. That's probably the most famous one, where you had thousands of people pooling their money without ever knowing each other into a DAO to try to buy the Constitution. The other function of a DAO is voting. So if you then go and pool that money, what you get in return is an asset. So you can either get a token, it can be a fungible token that can be swapped, or you can get an NFT, a non-fungible token. And what those assets give you is the ability to vote. So first I put the money in, that creates the treasury. Then I get an asset out, which gives me the ability to vote. And so what we're now seeing is you're seeing decentralized technology with decentralized governance structure, DAOs, and that is kind of the only thing that really you can call as a truly decentralized institution. And then if you look back at the title, it's a spectrum. It goes all the way from one end to the other end. And yeah, as Evan says, even DAOs can be centralized. And even DAOs that are decentralized still have issues where you could have 4 people that control the keys to the wallet. And if they don't like the way that someone's voted, they can go against it. So this is imperfect, it's a spectrum. But really what I'm trying to do is just illustrate the spectrum of decentralized to decentralization to decentralization. And hopefully that's done that. All right, so now let's go a layer deeper again to what is DeFi architecture. What this is showing, so we can position it, it really is showing this area here, the on-chain world, blockchain metaverse. So what you have is you have different layers. So the base layer is what we call layer 1. Layer 1 is the settlement overlay and the asset overlay, which basically is the ledger that things get printed on. It gets printed every 12 seconds. And so this is the example with Ethereum. We spoke before, there are different layer 1 protocols. I mentioned Phantom Foundation, Polkadot, and Solana. There's no shortage of them, but that is the base layer at which the transactions get printed onto the ledger, and then that block gets updated, and then the next block gets updated, and so on and so forth. And so it consists of a settlement overlay and an asset overlay. Layer 2 is a relatively new innovation in practice. The theory's been there forever, for about 20 or 30 years. What that does is another way of thinking about it is transaction rollups. So the problem that layer 2 solve is the gas fee challenge. So if you recall that I had to pay 10% of my Uniswap transaction in gas fees to get that transaction prioritized, what rollups do is take hundreds or thousands or millions of those transactions, roll them up, self-explanatory, into a single transaction, and then that's the transaction that then gets printed onto the blockchain. And so rollups are going to be foundationally important to the scaling of blockchains and to the scaling of Ethereum, because all of a sudden that 10% gas fee should drop down to a fraction of a fraction of a fraction of a percent. And we're starting to see more and more different companies or customers building rollup technology. And rollups can be based on different industries. So you can have a DeFi rollup, a general purpose NFT rollup, a general purpose gaming rollup, or you can have protocol specific or app specific rollups. So another example is the DYDX, the exchange that I talked about before. They have a rollup and it's built by an Israeli startup called Starkware. And so what you have is you have layer 1 and layer 2, and that is effectively the transaction layer and the ledger. Then on top of those, you have the protocol layer. If you think back to what I was showing you with Uniswap, where they had what was it, swap and pool functionality. That's two kinds of protocol functionality. But in reality, there's dozens and dozens of more. There's lending functionality, lending protocols, insurance protocols, derivative protocols, marketplace, so on and so forth. That functionality layer is then what decentralized apps or dApps or DApps get built on top of. And that is the consumer facing or the business facing application that we will end up using. So Uniswap has built their own decentralized app on top of the Uniswap protocol, but there are dozens of apps that are built on top of Uniswap, dozens of apps that are built on top of the Phantom Foundation, on top of Solana. And all of these apps, as I said before, are completely composable, where I can pick protocol from completely different organizations or from different DAOs, and I can compose my own app. So I can take insurance from one, DAO from another, derivatives from another, asset management from another, completely permissionlessly. I never have to sign a commercial agreement with them. I never have to talk to a business development manager. I never have to go and work with their compliance lead. I can go, and as long as I follow the protocol requirements, as long as I code to their requirements, I can then build apps on top of those. And so what you can start to see when you think about how these different layers are built, the speed and the pace at which things can be built with very, very few people is the whole reason that if you think back to the top column in that slide where I said that the unknowns are exploding, it's because of the way this is structured. It takes very few people, very few resources to go and build something. And if it doesn't work, you stop and you build it again, or you try something different, or you swap out one protocol for another. So the pace at which things are being built, the pace at which things are being tried out, there's no other technology that's existed that has allowed people to innovate at the pace and the speed that you can through DeFi. So that's the overview. That's kind of the architecture. Hopefully that is helpful. One thing that I want to note, and I think that this is important, and this is actually, to be honest, this is the slide that kind of started me down my rabbit hole, was talking about NFTs and DeFi. And I think this is really important because one of the things that I get asked quite often is, are NFTs, is it a bubble? Why should I care? It's just a bunch of art. It's just a bunch of JPEGs. I'm not even going to express an opinion on that because I think that's beside the point for what the point that I want to make. And I think the bigger and more important point. And what that is that we live in a world of non-fungible assets. So the receipt that I get at the end of a meal is non-fungible in that it is one of one. It's only for me at that time, at that restaurant with those food. An invoice that one business sends to another is non-fungible. My home loan is non-fungible. My home title is non-fungible. All of these assets at some point in time, and this is just I think this is a helpful timeline, are going to move from off-chain assets and are going to become non-fungible off-chain assets to non-fungible on-chain assets, non-fungible tokens. And so what that means is that all of these different institutions that are built up around these non-fungible assets. So banks that are the only ones that can provide loans, and you get a license from a government entity, and a land title branch that only they can now provide proof of title, and government ID, where only that government is able to verify who you are. Over time, and whether it's by 2030 or 2050 or the year 3000, I don't know. I'm just predicting that this is the way that it's going to go in the future. Those are going to move from off-chain to on-chain. And so NFTs are going to go from being collectibles, which is where we are here, to the financialization transport layer for intangibles, and then off-chain assets. And I think that's a really important point. I think it's a really, really cool point that you can actually start to conceptualize where this is going, and not just that it's about collectibles or that it's about investments, but it's actually about how we structure and build governance in society. So anyway, it might get there in 50 years, it might get there in 100 years, it might get there in 1,000 years, but I've got a high level of conviction that it'll get there eventually. All right, so that's the intro. Now, what is DeFi made up of? So first thing I want to start with is just making the point that centralized finance, as we know it, is actually really amazing. The fact that I can go into a merchant in the UK and I can take a card, a piece of plastic that has the Visa logo on it, and pay for something and walk out of that merchant without ever giving the merchant money, without the merchant actually ever getting anything from me or knowing who I am, and that merchant knows that they're going to get paid, even though I live in Australia, is a phenomenal innovation. But it also requires lots of different parties in between. So this is, if anybody knows, a four-party credit card model. It's not just the merchant and the customer. There's the acquiring bank, the one who has the tapping machine. There's the issuing bank, the one who gives me the credit card. And then there's the scheme, the one who sits in between. And because each of those is required, and because they're building and managing quite complex infrastructure that is required for trust and for permission, there's a fee to it. And that fee can often be quite expensive. And so you get someone like Walmart, who at times has paid multi-billions of dollars in what's called interchange. Or in Australia, you have merchants that surcharge. So when I go into a merchant, I actually have to pay different amounts based on what card I'm using. It's just complex and it creates friction. And so while the model is amazing, because it requires intermediaries, it adds cost to it. International business-to-business payments is similar. So this is just an illustrative example of what happens when somebody in LA buys something from someone in Brazil. All the different intermediaries, all of the different steps that it goes down. And every step is basically a cost because the person who is involved in that step has to build infrastructure, has to pay their team, so on and so forth. So CeFi is amazing, but because of the complexity that's required for running it, there's a cost to it. What DeFi does is DeFi, or crypto, removes the intermediaries and it becomes truly peer-to-peer, where I send my transaction directly, the cryptocurrency, directly to the business or directly to another person. And there's no need for the financial intermediaries. There's no need for the trusted third parties because it happens via the internet and in real time. So that was the innovation that started with crypto. But there was a fundamental problem that got in the way of actually scaling it. And it's illustrated really neatly by the very first Bitcoin transaction ever. So this happened in, I think 2012, but somebody I'm sure will correct me if I'm wrong, where somebody wanted to buy pizzas, they wanted to use Bitcoin, so they sent the receiver 10,000 Bitcoin, and they received 2 Papa John's pizzas. First crypto on-chain transaction ever. Really cool, proved that it could be done. They got 2 pizzas in exchange. But I'm sure that you can very quickly see the challenge. It's the 2 most expensive pizzas ever. So at today's value, and by the way, this is probably wrong now. The price changes so quickly that unless I build a direct feed from from an oracle, I'm going to struggle to keep this up to date. At the time that I created this a couple months ago, it was $600 million for 2 pizzas. So if I'm a merchant and I can see that the currency that I'm getting paid in is fluctuating that much, is that volatile, I'm just not going to take transactions in it, because to me, I would rather get dollars, which I know are going to be worth today, tomorrow, a month, a year from now. And so even though you could transact with crypto, even though I could send money to someone, it was incredibly ineffective and inefficient as a means of exchange for any transaction other than swapping it as an asset. And so DeFi exists because of 2 innovations, and I'm going to talk about those now. The first one is what we call stablecoins. So stablecoins are an asset-pegged stable cryptocurrency that allows users to materially reduce the volatility from the value of their collateral. And I'll talk in a moment about what a stablecoin actually is. But for now, just take it as an asset that, just like the USD, I know what it's going to be worth today, tomorrow, a month from now, a year from now. So it is a cryptocurrency, but that is pegged to the value of a dollar, the euro, the yuan, any form of collateral. And what that means is that now that I know that there is no more volatility in that cryptocurrency than in the US dollar that I take, it unlocks a world of financial use cases. So all of a sudden, I can now borrow against it, and I know the value of my collateral will stay the same, or the value of the cryptocurrency that I'm lending will stay the same. I can use it for insurance. So again, I know that the claim, whatever that, if I make a claim, that the payout from that claim is actually going to be of the value of what I'm claiming, as opposed to some wildly fluctuating cryptocurrency. Derivatives, remittance, B2B or B2C payments, which are critical for mass adoption, and many, many more. And there was just an announcement recently, and I would encourage you guys to go look for something called Solana Pay. So Solana is one of the layer 1 protocols that I mentioned. They've partnered with a company called Circle, and I'm going to talk about the Circle stablecoin in a minute, the USDC. But basically what they've done is they've built the ability for consumers to send stablecoins directly to merchants. And all of a sudden, this now cuts out the middleman. And again, it's going to be a fraction of a fraction of a fraction of it. So what are the different kinds of stablecoins? And Evan, you're right, there's algorithmic stablecoins. I'm not going to talk about Terra in this, although I do need to add to the presentation. So thanks for calling that out. So stablecoin features vary, but there's two basic kinds: centralized and decentralized, and then a whole lot of variation in between. So the largest one is called Tether. Tether is centralized in that there is one company and a board or an executive team that actually controls the treasury, controls the value, controls the peg. It's meant to be wholly reserved. It's meant to be one-to-one. There is a lot of controversy or FUD about whether they are actually holding every single dollar that they get when they give out $1 worth of Tether. I'm not going to get into that, but let's just say it is reserved to some fraction of wholly reserved. It's one-to-one, and it's dollar-backed. So that's one kind of stable coin. I mentioned before USDC. That is also a centralized stable coin that is wholly reserved, in that every time they get a dollar, they then send out $1 of USD, and they hold all of those dollars in treasury, and they basically just earn very, very low yield interest on it. So that's kind of how they make their money. Fully audited, very transparent, and ultimately now they're growing faster than Tether because there's an additional level of transparency, and that's one-to-one, and that's dollar-backed. So those are the centralized ones. And then you have decentralized stablecoins. So the most popular one is called DAI. It is decentralized in that the DAI is a stablecoin. DAO is the governance token. So you can go and you can buy DAO on a market, and then you have the ability to vote in a whole range of different proposals for MakerDAO. That's the organization, MakerDAO, Maker Decentralized Autonomous Organization. But because it is decentralized and because it is crypto backed, so rather than being backed by a dollar coin, it's crypto backed, you have to over collateralize it. So USDC, I put in $1, I get out 1 USDC. For DAI, I put in 1.5 Ethereum and I get $1 worth of DAI. The reason that they do that is to be able to withstand the fluctuations of the cryptocurrency and to maintain what they call a soft peg. So to be able to maintain that one-to-one peg. So it's not fully free of the fluctuations of cryptocurrency. You have to over collateralize it, but that is how they maintain the one-to-one, the one DAI to $1 peg. But it's a very inefficient use of currency. So rather than me be able to do one-to-one, I'm actually locking up another 50% that in reality, I should be able to put to use for whatever other kinds of financial activity I want to do. So they're over collateralizing, which is how they maintain the peg, but it's also an inefficient use of currency as well. So that's the downside. And then, as Evan mentioned, there are also algorithmic stable coins, which I'm not going to get into the detail now, but Terra, which is made by Luna, is a popular one. So if you're interested in that, go and have a look at that. And then this is just a graph showing the growth. And so as you can see, the explosion of stable coins goes directly in line with the explosion of DeFi, because DeFi is dependent on stable coins, on a stable asset. You can see it exploding. But then I provided this slide just to give you an idea of scale relative to national currencies. So the yuan in circulation as of 29 November 21 had 4.6 trillion in circulation. US dollars had about 2 trillion. Euro was about just under 1.5. Total value of stablecoins is somewhere around 200 billion. So it's growing fast, but in terms of the overall scale relative to national currencies, it's still very, very small. That's innovation number one. And that innovation, to be honest, was a financial innovation. It's not really a technology innovation because anybody can create a stable coin if they have enough people that are willing to give them some sort of asset to back it. But it is still a very important innovation in that it's what allowed DeFi to go. Now, what is the actual technology innovation? Smart contracts. So smart contracts are the ability to create programmable money. So think of it as it's a dollar with if this, then that written directly into it, into the current cryptocurrency. So if I had the ability to give somebody a $10 bill, but I could program into that $10 bill that if this person didn't send me a text message within the next 5 days, then that $10 bill automatically reverts to me. And you could program that into the smart contract of that $10 bill. That's what a smart contract is. And that's really what makes Ethereum or kind of any smart contract enabled cryptocurrency smart contract enabled. And what that does is that is really what's led to then an explosion of different use cases, decentralized use cases using smart contracts as the method of execution. And that's really then the second innovation that's led to the explosion in DeFi. So just a couple interesting examples. MakerDAO, we've spoken about that previously. If the value of the ETH collateral falls below 1.5, so if it falls below the collateral threshold, then I auction off that collateralized ETH if it's not topped up. There's no warning, there's no messaging, there's no banker that calls you. If it falls below that amount, then they will automatically, via the smart contract, so the smart contract is executing this whole thing, put that collateral on some decentralized exchange and someone else will buy it. So that is an example of a decentralized smart contract and how that then is used in stable coins, in a decentralized stablecoin to maintain its peg. Another example is NFT collateralized loan. So there's plenty of companies that are doing this now. One is called NFTFi.com. I can use my NFT and I can borrow against that. But if the loan is not repaid back, not repaid in time and in full, then that NFT automatically reverts to the person that's lending it. So it's a marketplace. I lend against that NFT. If I'm not paid back, then that NFT goes straight into my wallet. Again, you don't have a banker warning. There's no commercial negotiation. It's just executed on the smart contract, executed by code. The smart contract is public. Anybody can have a look at the code. It is immutable. It is onto the blockchain. And so that is, again, really the other innovation. One more example is NFT royalties. So you can build royalties for a collectible NFT into the smart contract. So I can say, I create an NFT, I sell it for $100, but in that smart contract, I say each time that NFT gets sold to a new wallet, gets sold to a new person, a new wallet, I continue to get 5%, or I get a decreasing amount, or I get a fraction of it. And so what you're starting to see is that people are taking the ability to execute via the smart contract, execute via the asset, whether it's a fungible or non-fungible asset, completely removes the need to have, when I say completely, that's maybe a bit of an overstatement, but it removes the need to have legal contracts, to have courts that can reside over those legal contracts, that can have a compliance officer that then reviews the contract and reviews the smart contract, and so on and so forth. And so with those two innovations, you've got, number one, stable coins, a stable asset that allows me to trade on chain, to lend and borrow on chain, knowing that the value of my collateral is going to be stable over time. And number two, smart contracts that removes the need to have any sort of centralized institution to review or measure or litigate the execution of that contract. And that's in a nutshell DeFi. So where is the money in DeFi? I think this is just a neat chart just to show actually where the value is locked. We talk about total value locked. As you can see, predominantly in lending. So this is people lending their assets to an exchange or to another person and then earning yield on those. Decentralized exchanges like Uniswap, assets being non-fungible assets, derivatives, and payments. So that's where the money's locked away. You can go on apps and you can stake your own tokens. One example is Celsius, a customer of ours out of Israel, where you can go and you can stake your coins. and you can earn a yield. There's SwiftX locally, allows you to lock up your assets and stake those, or to lend those assets to others. Another company, a local company of ours, does crypto lending, where you can actually receive fiat currency. So you're just starting to see that there are all of these different companies or all these different apps, some decentralized, some centralized, that allow you to do it. And then finally, just leaving you with the view of just how fast DeFi is growing. This is probably my favorite DeFi data website. It's called DeFi Llama. And you can just go and have a look. I think there's about 600 different coins listed there. You can see it based on all of the different kinds of layer 1 tokens, based on the different kinds of protocols. And it just gives you a view of what there is, the value of it and the volume of it. So what's next? There is an entire world out there to cover. I've covered, as I said, a fraction of a fraction of a fraction. I'm not even going to read through all these, but just take it that there is no shortage of things that are out there that people are interested in. So if you're interested in regulation, if you're interested in lending, if you're interested in derivatives, if you're interested in high frequency trading, there's going to be some rabbit hole for you to go down. And then that's it. So thank you, and GM. For those of you that don't know what it means, go Google it. That's going to be the start of your little rabbit hole. It's my favorite crypto meme. And then please go ahead and complete the survey. I think that Rian is going to pop it in the link here. There you go. Yep, Lodo's another one of ours. Thanks, Joseph. And guys, just go reach out to me. I'm always happy to talk about this. I am doing one-to-many presentations for companies as well. So if you're part of a company and you think that your executive team wants to learn about this, or you do lunch and learns and things like that, this is an open invitation to ask me. I'll do my best to be able to make that happen. But I hope that this gave you what you want out of it. And thank you everyone very much for your time.